We just got the latest inflation report, and what it says is that inflation has fallen to 2.9%, and that is the lowest CPI number that we have seen since March of 2021. Now, a quick reminder that a falling inflation rate does not mean that the prices of things are falling. It means that the prices of things are rising, just not as fast as they were before. Now, when you couple this falling inflation rate with the fact that unemployment is rising, unemployment has jumped up to 4.3%, which is the highest unemployment that we've seen since 2021. This is what some people are calling a green light for the Federal Reserve Bank to start cutting interest rates this September. Let me read you what the global chief economist for Citigroup had to say. Quote, "I think this inflation report is a green light for the Federal Reserve Bank to begin cutting interest rates this September." Now, what you might find valuable is where inflation is and where it is not. So here are the 4 places where we saw the highest inflation for the last 12 months. Number 1 is, can you guess? Number 1 is auto insurance, which has grown 18.6%. Number 2, rent costs, 5.1%. Number 3, housing costs, 4.4%. And number 4, restaurant costs, which is up 4.1%. The bottom 3 areas where we saw the least inflation are number 1, used car prices, which have fallen 10.9%. Number 2, rental car prices, which have fallen 6.2%. And number 3, furniture prices, which have fallen 5.2%. So what I want to do in this video is I want to go over number 1, what does this new report mean for inflation? And number 2, what does this mean for interest rates and the Federal Reserve Bank? And of course, what does this mean for you? So let's jump right in, starting with inflation. And I want to start with this reminder that inflation is a compounding number. What that means is that even though we're seeing this lower rate of inflation today, this lower rate of inflation that we're seeing now is on top of last year's high inflation. It's on top of the even higher inflation the year before that. It's on top of the year before that's inflation. Inflation compounds. So if something cost $100 last year and you had 2% inflation last year, that means the price of the thing rose to $102. And then if you saw another 2% inflation on top of that, that means that this thing is going to cost you even more than $104 this year because it's 2% compounding inflation. So inflation compounds, and when you see a lower rate of inflation, that does not mean that the prices of things are going down. It means that the prices of things are still going up, just not as fast as they were before. And secondly is, in addition to the CPI number, there's a separate inflation report which the Federal Reserve Bank likes to look at, which is called core inflation. Core inflation is when you take the headline inflation numbers and then you strip out what they call the volatile numbers, which include food and energy. That's what the Federal Reserve Bank likes to look at. And core inflation came in at 3.2%. Why is that significant? Because remember, the Federal Reserve Bank wants to see 2% inflation. But when they say they want 2% inflation, they're not looking at the CPI numbers, they're looking at the core inflation numbers. And up until just a few months ago, what the Federal Reserve Bank used to say was that they're not going to cut interest rates until they see inflation fall to 2%. And then just recently, what the Federal Reserve Bank started to say is we're not going to wait until we see 2% inflation. We're going to wait until we see inflation heading towards 2%. A very different definition, because actually achieving the 2% and going towards 2% are two very different things. And remember, the Federal Reserve Bank is looking at core inflation, which is higher than the CPI inflation. Now, the reason why this is significant is because inflation is obviously manipulated by interest rates. And the second factor that the Federal Reserve Bank is looking at, in addition to inflation, is unemployment numbers. So they're seeing inflation rates start to go down, and they're seeing unemployment levels start to go up. And this is what now is fueling many people to believe that the Federal Reserve Bank is going to cut interest rates starting in September or maybe earlier. Wall Street has a lot of people pressuring the Federal Reserve Bank to do what's called an emergency interest rate cut because they want to continue seeing the stock market stimulated. However, this is where you want to understand the different factors that affect inflation, because one of the biggest factors that influence inflation are, of course, housing costs. And the top 2 things, or 2 out of the top 3 things that are influencing inflation today are, of course, housing costs. The number 1 is auto insurance prices, but then you have rent and housing costs, which are still above what the Federal Reserve Bank wants to see at 2% inflation. Now, the reason why that's significant is because housing is one of the most sensitive assets to interest rates. When interest rates go up, your buying a house becomes significantly more expensive because now your mortgage is more expensive. People generally buy homes with a mortgage. And so if interest rates change, that affects housing prices. So let's play through the scenario. If the Federal Reserve Bank were to start cutting interest rates and it's cheaper to get a mortgage, well, that could create a situation where more people now want to go out and buy a home. And if you start to see more buyers say, you know what, it's time to go out and buy a home, and now you start to see more bidding wars, that could push home prices higher. Now remember, housing costs are one of the biggest factors that determine CPI data. And if home prices start to go higher again because you start to see more bidding wars, well, that could start to make the inflation problem worse as well. That's why you want to pay attention to that. Not to mention the fact that the Federal Reserve Bank themselves have said that inflation for housing prices is probably not going to come down to pre-pandemic levels for a little while. Let me read you what the Federal Reserve Bank of Minneapolis said. What they said is that they expect shelter inflation, meaning inflation for housing costs, will likely remain elevated for the rest of 2024 and in 2025. They project shelter inflation to reach 4.8% year over year in December and stay above pre-pandemic levels through the end of the year in 2025. So the Federal Reserve Bank knows that housing costs are going to continue to stay high. Housing costs are the most, or one of the most sensitive asset classes to interest rates. So if interest rates start to go down, that could potentially elevate that some more. So something you want to pay attention to when it comes to inflation numbers, because, well, inflation compounds. What we've seen is that the wages for the average American haven't kept up with inflation. And now the Federal Reserve Bank wants to start cutting interest rates, which could then make the inflation, especially for housing prices, worse, assuming that people can continue to afford to buy a home. Now, of course, we've been seeing a slowdown in spending, and I've been talking about this in quite a few videos. We've talked about this in Market Briefs. Market Briefs, by the way, is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. But when you start to see more and more people start to struggle making their payments on their credit cards, struggle making their payments on their car, what does that signal? It signals that people are getting tapped out with how much debt that they can take on. And just a couple of days ago, Home Depot released an earnings statement where they said that they are predicting slower same-store sales for the rest of the year, even less than what they had originally predicted, which was a lower number, because they're worried that consumers are getting tapped out. But what was interesting about what Home Depot said is that they said that because interest rates are expected to fall, people are just deferring their home improvement projects. They're waiting for interest rates to fall because when interest rates fall, it's going to stimulate the economy. It's going to make borrowing money cheaper. So people are going to be able to go out and borrow more money and do more of these home improvement projects, which was a very interesting thing to say because it shows you how much value and how much power people are putting on these potential interest rate cuts. So just something interesting that you're going to want to keep your eye on. Now, as we approach this election, what you also want to think about is the different factors that affect our economy, because we live in a spending-based economy. And what a spending-based economy means is when you spend money, somebody else makes money. The more you spend, the more somebody else makes. Now, obviously, you are a consumer, I'm a consumer, everybody's a consumer, but one of the largest consumers in the United States is none other than the United States government. The United States government makes up about a third of total spending in the United States. And how does the United States government get their money? Well, they get their money from taxpayers through tax dollars. And they also get their money from the Federal Reserve Bank and by borrowing money. See, the United States government, when they collect taxes, they then take this money that you pay them and then they spend this money by building bridges, by building roads, by investing in the military, by hiring teachers, by doing a whole bunch of different things. But then what the government does is they spend money that they don't have. That's why we have this very large national debt. It's because the government has spent $35 trillion that they don't have. Now, when you have all this national debt, what's interesting is the government has to pay this money back plus interest. Now, one of the fastest growing expenses, actually the fastest growing expense for the United States government, is not the military, it's not Medicare, it's interest expenses. And one of the reasons why is because, well, the United States government has took on so much national debt. And secondly, the United States government does not have a 30-year fixed rate mortgage on this debt. They've had readjusting rates on this debt. And so over the last 12 to 14 to 16 to 18 months, more and more of this debt has readjusted at significantly higher interest rates. So it's not just consumers and businesses that are keeping an eye on what the Federal Reserve Bank does with interest rates, it's also the United States government. Because the fastest growing expense is interest payments. And right now, the United States government is spending more money on interest than they are on our own military, which kind of poses a problem, because if this interest expense keeps rising, how long is it before most of our tax dollars are going to interest payments? In fact, how long is it before all of our tax dollars are going to interest payments, and then we have to finance paying back our own interest payments? You got a Visa payment you got to make, and you pay off your Visa with your Amex. You can start to see where that's a problem. Now, there's the macroeconomic issues, the microeconomic issues, but what this means for you is I want you to understand the different things that are happening with interest rates, the different players that are involved with inflation and interest rates, but most importantly, how can you find the opportunity and how can you build wealth? Because there's a lot of emotion out there. Trust me, I get it. I own a media company. But what you want to understand is, how do you cut through the noise? How do you build your wealth? And the way you do that is by three parts. Number one, being financially prepared. You've heard me talk about this. Being financially prepared means having cash to protect you. It means having cash to capitalize on investment opportunities. You could see an amazing investment opportunity tomorrow. And even if you're not one of the people that panic and run away, if you don't have any money to buy that investment, it doesn't do you any good. And so the first thing is you got to get your money right. Get your cash in order, save some money to protect you, save some money to be able to capitalize on opportunities. Number two is you want to be financially educated. And what that means is you got to know, what is your investing strategy? Are you investing in real estate? Are you investing in stocks? Are you passively investing your money into ETFs or index funds? Or are you looking for individual companies that you want to invest in? Know your strategy, learn how to analyze investments. And the third thing is you want to pay attention to financial trends. What industries do you want to be investing in? Where is the money going to? Because you don't want to invest your money into a dying industry. You want to invest your money into an area where more money is flowing, and not every good investment is a good investment for you. This is why you want to build your own financial education. You want to start studying the financial trends. You want to pay attention to what's happening in the markets, but not get manipulated by the emotions, because what I can tell you is, as we get closer to an election, it is going to get a little bit weirder, a little bit more emotional. And that drives clicks for media companies, it drives ad dollars, but it also moves your money if you are trading or you're making investment decisions based off of what media companies are saying. And this is where I want you to be able to cut through the noise of the traditional media companies and understand what's actually happening, because emotions are the enemies of profits. That way you can find the opportunity, that way you can build wealth. This is one of the reasons why I'm so adamant about building market briefs, because all of the financial news is just in one email. There's no sensationalism. It's all right there, and we work to keep it as unbiased as possible. So if you haven't joined Market Briefs yet, it's completely free. I got the link for you down in the description. And with that, I will see you on YouTube tomorrow.